if you could identify what you see as the biggest risk you face as an apartment syndicator.
Mm-hmm. From an insurance point of view?
No, it does not have to be an insurance point of view. And I guess I want to make that very clear. If you can think of it in a way of just, I mean, if you tie insurance in, that's fine, but I'm really not looking for insurance.
I can give you one on the insurance. So goes back to building construction best practices. And in the 80s, assets were built without fire sprinklers. So you'll get to know that things that are built in the 90s, and particularly in the early 2000s, fire sprinklers are everywhere because it was required by code as code changed over the years. But if you've got a 1980s asset or earlier, they will probably not have fire sprinklers, which means your insurance for fire is going to go up and your premium is going to go up. So having the newer type of construction, we talked about the 9-foot ceilings. Typically with 9-foot ceilings, you'll have fire sprinkler heads. In my experience, things that are built in the mid-90s and soon or later will have fire sprinklers, and that will help you with your insurance. Hail damage, roof insurance, all that sort of stuff. You've really got to be on top of when roofs need to be replaced. Depending on when you're buying, like in Texas, they have a lot of hailstorms. So a lot of insurance companies will replace roofs when the hailstorm comes through. And we need to really be on top of that when we look at the due diligence, because a roof can cost you $300,000-$400,000, and if you haven't budgeted for it, well, that's taken out of the exterior budget. Your leasing offer is not going to look as good. So that's the type of insurance risk you got to look at as a syndicator. In terms of the biggest risk, well, there's so many risks when you're syndicated. There's obviously finding the right deal. You know, if we start from the beginning, finding the right deal, underwriting it correctly. What assumptions have you put into the underwriting to make sure that you're protecting your investors' principal? Because we invest in real estate to make money. We don't invest in real estate to lose money. I think in terms of where we are in the market cycle, we are looking at newer types of assets. From a risk point of view, and this ties into insurance. We look at newer build assets because there's less skeletons in the closet. They're individually metered, right? A 1990s or earlier built in the 2000s, they'll have individual meters on water, on electric. They'll have fire sprinklers. They'll have individual heaters. They'll have individual HVAC systems. So there's less likely to have issues as you move down the track through ownership. There's less heavy lifting we have to do. So you can go and buy an asset that was built in 2000s at the same cap rate as you can buy an asset that's built in the 1990s, but 1980s, I should say. But there's going to be a lot more potential risk items from an insurance point of view and a construction point of view that could come and bite you in the ass later on. So we look at that, we weigh that up and say, okay, well, I'm going to spend less money on the front end, but I still get the same cap rate coming out of the gate. Why would I go buy a 1980s asset? The second thing is, where are you buying? Core in-plus value add locations are extremely important. I would not be buying in the tertiary market right now. I'm buying where the population is growing. I'm buying where there's multiple employers. So people always have a job. I'm really looking for a value add proposition. I don't want to buy something that is being touched by someone else, because that's not the true value add. There's all these things out in the market right now, or, value add, but the whole exterior is being touched and, 30% of the units are being touched in the interiors, and the brokers will sell it to you as we'll just come and finish those off. Well, one things that we've seen, as I explained before, you don't ever do 100% of the units. You've got to come in and do 50%, maybe a silver package. You need to do maybe some that are the gold. Maybe you only do 10% of gold. And you leave the rest as classic because you want to offer that smorgasbord to people in these markets that, remember, we're in the game of affordable housing. We can't, you can't come in and expect to buy a 1980s asset and increase the rent to $2,500 a month like you get in Portland and Los Angeles. We're not in those markets. And if you are in those markets and you're buying and syndicating, I bet you my bottom dollar, it's not cash flowing because you're buying it at a cap rate of 2 and 3%. So you've got to look at, there's so many different risks, from insurance to the type of build to where you're buying and where the path of progress is if you are buying in those secondary markets. And how is that going to help you be future-proof your investment to make sure that the value is there and that your investors' capital is protected and you're going to make money in the long term. So a number of things there for your listeners.